All right. Are we live? Well, welcome traders. Shawn Lucas here, head trader of the Apiary Fund. We apologize for getting started just a little bit late here. We had some technical difficulties with attacking Facebook. Anyway, great to be with you. I'm here with my good friend and trading buddy, Nate Allred. Great to have you here, Nate.
Yeah, it's good to be here.
Look forward to this. This is your first time, isn't it?
It is, yeah. It's my my rookie season. So
rookie season.
Yeah, so I'm excited to be talking about the Euro today. So
yeah, we've got a great topic coming up for you. Before we get started, just a reminder, we've got a competition or a contest going right now. We're calling it the Trade a Day contest. What we're looking to do is encourage and promote, hit a consistent pattern in our trading. So, every day, wake up at the same time, go through the same routine and start to build some good trading habits. To enter into the competition, all you have to do is place a trade and post the results on our Facebook page. It doesn't even matter if you're trading through your Apiary account or on your own. I think what we're interested in is that you're getting into this habit of trading and trading often. I think it just helps. It helps you get in tune with the market.
Yeah, I think practice makes perfect, right?
That's what they say anyway, right?
You bet.
So anyway, make sure you post your trade results on Apiary Fund at the end of the month. End of January, we'll go through and draw a lucky winner. Each time you submit a post, that's an entry into it. One a day, limit it to one a day. But at the end of the month, we'll have a drawing and we'll give away a set of Apiary coins. So pure silver. 99.9% pure. So
that's right.
Anyway, well, Nate, great to be with you today. What do you say we just dive in and start talking about the euro and the U.S. dollar? And
yeah, absolutely. I think one of the reasons we picked this topic is because the euro's been really running lately, right? And so right now, I want to take the stance of just kind of a technical look at the technicals of the euro. Right now, we're sitting between 122, 123, and in the short term, really the thing that's stopping us, or the next resistance level, is at 123.50. We have a Fibonacci extension, right?
Right. Yeah.
And so historically, this isn't uncommon to see it where at the levels that we're at right now. And in fact, back in 2008, 2010, 2012, there were some points of support where the euro did find some support at those levels, and now we broke through those, and now we're kind of back up into those levels, which will create resistance points. So it's not really unprecedented to see where we're at, and so in the next little while, I kind of expect to see some resistance coming into the market over the next couple of days and weeks. We'll probably see consolidation before it strengthens and actually goes and breaks through this 123 level. But once it's past 123, there's really nothing stopping it from going to 125, right?
Oh, yeah. Yeah. I mean, I think, you look at it and it's a lot like trading in the trading room, right? For months and months, we were looking at that 120 level. And, the market rallied up, hit it, pulled back, started forming this beautiful head and shoulders pattern. We're thinking it's going to drop, and then all of a sudden it strengthens and then it breaks through. So, just like when we're in the trading room, whenever you get that breakout trade, right, that breakout bar, we're looking for the majority of them move to happen within 2 to 3 bars, right? Well, we're 2 to 3 bars into the breakout. So, I think we rally all the way up, hit the one sound coming through.
Low. Nate's is good. Yours is low.
Mine's low. That's try and adjust that microphone. So anyway, we break through that. We rally all the way up to that fib extension, and then we start to look for the next trade setup, right? So, for me in a lot of my trades, you catch the breakout. You wait that 2 to 3 bars, let that thing run as much as it can, and then start to close out those positions. So, here we are 2 to 3 days into the breakout. I'm looking to start to close out some of these, take some profit off these breakouts, and then wait, right? And wait for the next opportunity to set up.
Well, I think as a beginning trader, not that I'm a beginning trader, but I talk to a lot of beginning traders, and one of the hard things that they have to get through is they think that because I'm sitting in front of the computer, it's a good time to trade. And what I'm hearing from you is kind of the exact opposite. Right now, I'm getting out of trades, and then you wait. Sometimes you have to wait a day. Sometimes you have to wait a week or a month, right?
Yeah, like on the last, that at that 120 level, it was waiting a month, right, for it to break out.
Yeah, absolutely. What types of so what tells you to get into the market? I mean, at what point do you say, I mean, you're sitting in front of the computer, okay, now's a good time. How do you, as a beginning trader, or even just somebody who wants to invest, how do you know when to get in?
Well, I mean, you and I have seen this all the time. A lot of rookie traders will try and chase this move, right? So here we are 2 to 3 bars into it. The pros are saying, hey, it's time to maybe close out these positions. Some of the rookies are saying, oh, look, it's running. We got to jump in. And so a little bit of timing is super important, right? And knowing when the right time to get in, when it actually getting in right when it's breaking, and as opposed to waiting, for 10-20% confirmations.
Well, for me, those price points are very key. That, like you're saying, the timing. You look for the pattern to happen, and then once the pattern happens, at that point, not when I'm sitting in front of the computer, but at that point, regardless if I'm sitting in front of the computer or not, is the time that we should be getting into the market. So we let the price and we let the price pattern dictate when we get into the market. So, okay, so we missed this move on the daily chart, or some people I imagine did, and so so we're going to be waiting for a couple days, couple weeks. How do you then enter in? I mean, I think for me, what I do is I go in on a lower time frame, maybe an hour trade. I mean, we're talking, long term for you and me. I mean, daily chart is super long term, right?
Long, right?
Right, yeah, exactly.
We're forced in that trading room to get our trades in and off the books in less than an hour. So.
Right, exactly. So I think there's advantages to going to a lower time frame to play short-term momentum, which is what you do. You're fantastic at it, but looking at those price points to get us in and out. But I don't know, what's your thought? Do you want to go down the route of talking more technicals, or?
Well, yeah, I mean, let's just draw something real quick, because you bring up a good point. So let me just kind of draw a rough sketch of what's happened in the Euros. We had this nice rally. We have this nice rally coming in. We had that head and shoulders pattern. We broke down just a little bit, and then we've seen the market rally up to that resistance level, right? So when we're breaking that resistance level, that's the time to get in for these, 2 to 3 day. You can't hear anything? Is the audio so low? I think we're just kept picking up audio off of Nate's microphone, so maybe let's just back and forth. So I think we're coming up, hitting these resistance levels, and when we break these resistance levels, right in there, that's the time to get in. And then we're looking for 2 to 3 bars of momentum to carry us. Once we get those 2 to 3 bars of momentum, we're looking to exit out of the trades. Well, if you drop down to short term here, you've got a lot of volatility forming those 3 bars on the short time frames. So, if I'm trading these shorter time frames, I'm using the bias that we're forming off the daily chart, but I'm picking up a lot of swing trades and a lot of trend following trades on that shorter time frame. So then we come up and hit that fib extension, that 128 fib extension. And now we expect something of a change in the bias in the shorter time frames, right? And And so we'll be looking for a slightly different trading approach once we hit that extension. And that's when I'm waiting. That's that patience, when patience comes in and starts to play an important role.
So what I'm hearing from you is that we're expecting consolidation. So you were trading trending systems, and now you're switching your view to consolidating systems, or as you like to call them, fading the market.
Yeah, some fade trades, some volatility trades where you're just trying to catch the up and down price movement as opposed to the trend movement.
Yeah, and I think as when I'm trading personally in the mornings, it's always good to keep in mind, is the system, is the strategy that I'm using today fit the market behavior? I.e., if I'm trading pullbacks, well, that works in trending markets. And I think a lot of people will trade, let's say a moving average cross system, which is clearly a trending system, in a consolidating market, and they wonder why they get chopped up and they lose money, right? And so do you just turn off your trending systems, your trending brain, at that point when you're taking, it off the table and wait for it to come back into a trending mode before you get back in?
Oh, that's a great question, Nate, because, you get used to something. We're used to this breakout trend for the last 2 to 3 days, right? On the euro. But then all of a sudden you have to adjust. And now you're looking for a different type of characteristic in the market, and that's a difficult transition to make. You're going to be 2 to 3 days into the new transition before you really start to get comfortable with that new way of trading. So I think that there's a skill to be developed in learning to recognize what's happening in the bigger picture. What's happening at the macro level, what's happening, with central bank action across the world, because that's going to be the stimulant that drives these trends. And so as we break up to this next level, now all of a sudden all eyes are going to be on what is Draghi going to do.
Well, maybe you could explain just for a second then, because, okay, so the lay folk right now, we're tightening, the Federal Reserve is expected to increase interest rates, right? Well, that should drive a stronger dollar, more money coming into the U.S. economy, right? But yet we're seeing the exact opposite. So the obvious question is, why? Maybe you could shed some light on all of that for us.
Yeah, I'd love to, because it's kind of a puzzle to be solved right now, right? Back in August, the Federal Reserve announces that, hey, we're going to start reducing our balance sheet. We're going to start taking money out of the system. Well, that should, supply should decrease, dollar value should be going up, and instead we're seeing, a tremendous weakening on the dollar. Similarly, we raised rates 3 times in 2017. We're looking at raising rates. We're looking in the future and saying, all we're going to be doing is raising rates. The dollar should be strengthening. So what is happening? Why isn't the dollar strengthening? Why is it weakening across the board? And I think you have to look at the big picture. Right now, part of the reasons why we broke out, on the euro is that Draghi said, "Hey, look, I'm going to be strengthening. I'm going to be tightening policy here in Europe." So that drives the euro stronger. And then look at what China's doing. What is China's net bank doing? And they're in a huge right now. They're printing more money than the United States is tightening. And so where is all of that money flowing right now? Well, cheap dollars are just flowing into the U.S. market like crazy. So it has the same effect on our economy as if no tightening is being done in the market right now. So here you've got the Fed working to tighten monetary policy, But you've got China over here printing loads and loads of money. That money is flowing into the U.S. and it's providing stimulus for the U.S. market again. So I think you're seeing this weird flow of money, across the world. What do you think? I don't know.
No, that makes sense. And as China, basically is doing quantitative easing and it's flowing into the U.S. markets, I guess the expectation long term, we're talking 2018, maybe even 2019, right? is going to be for a weaker dollar, a stronger euro, right? And because long term, that's the money flow. So it's a little different than the normal cut and dry fundamentals that we're used to seeing, right? Interest rates go up, dollar strengthens, right? That's usually what we're apt to expect. But this is kind of one of those anomalies where you have world events, playing on it.
Yeah, I mean it's all measuring the flow. You think of you put water in a pan like a cookie pan, right? And then you just inch that cookie pan up, one corner of that cookie pan up, and where does all the money flow? Right? It flows away from where that pressure is tightening or where things are going up, and it all flows to the lowest point, right? Well, I think that's what we're seeing right now. I mean, even the U.S. stock market is at all-time highs, and we've not seen a start to the year in the stock market like we've seen in 2018 and in probably 50 years. We've had the strongest start to the stock market in 50 years. Well, I mean, I think there's a correlation there with money flow. You've got U.S. We'll just think of it in terms of euro. A year ago, if you took a euro dollar, you'd pick up $1.03 U.S. dollars, right? You trade it, you get $1.03 U.S. dollars. Today, you take that same euro dollar and you get $1.20. Well, now you take that $1.20 and essentially you're getting a 20% discount on any stocks that are out there, right? So you've got this massive amount of money looking at the U.S. stock market and the weak dollar and saying, hey, I can throw a lot of money and get it cheaper than I could have a year ago. And so you've got this enormous amount of money flow moving into the stock market. And I don't see any end in sight to that, Something is going to have to change, and that cookie pan of water is going to have to, someone's going to make a move, and then we're going to see that money, that water shift into, the next place.
Well, and I think one thing to keep in mind, as we're talking about, money flowing into the U.S. or out of the U.S., and the levels that we're seeing right now at 123 with the euro, it's really not an unprecedented level, right? I mean, there's nothing special about 123. In fact, it's been up to 1.50, 1.60, right? Back in 08, right? And so, being at 1.22, there's really nothing special, and so there can be a lot more movement. But keep in mind, it's a long-term movement. It's not a short-term. Tomorrow, it's not going up 4,000 pips. I'm making a prediction right now that it's not going up 4,000 pips tomorrow. But long-term, we could see a big move because of the money flow, like you're talking about.
Yeah, and then and then each market has their own incentives. I mean, Draghi was talking, earlier this year and later part of last year, he makes a move and all of a sudden the euro shoots up, right? And all of a sudden now he's dealing with a strong currency as opposed to a weak currency. Well, if he wants money flowing into the European Union, he needs a weak currency. So a week ago he announces that he's tightening and we shoot up, another, 2-3 pennies on the dollar. And so, what is Draghi saying right now? Does he really want, the economy there, can it handle, this strong increase in the euro? So I'd be paying a close attention to what Draghi's going to be saying, and really take cues. For any trading bias, take cues from right now. I'd be focused, and we know what the Fed's going to do, right? I mean, that's no secret. The secret right now is what is Draghi going to do. So, in any of my reading, I'm going to be paying close attention to Draghi and trying to get a better understanding of what are his next moves.
Yeah, absolutely. No, and you've shed a lot of light, I think, on everybody here, and what we're doing.
All right, thanks, Nate. Well, I think we'll probably wrap up here. Anybody have questions out there? We'll try and maybe we can answer a couple questions here, Nate. What do you think? Have we got any coming through?
Yeah, if I knew how to get to them.
This whole Facebook thing, I don't know about it.
There's a comment that says, "Are we getting close to reversal range?"
Are we getting close to a reversal range? Yeah, that's a great. Yeah. So looking 100% at the technicals, yes, we're at a short-term reversal range. We're at a Fibonacci level, which is 123.50. Yeah, that's a great. Yeah. So looking 100% at the technicals.
Sorry.
Yes, we're at a short. All right, I apologize for that. I didn't want to get too much feedback, so sorry for the pause there. The great thing about being live is you get to see the good, the bad, and the mistakes, right?
You can't hide anything.
Yeah, exactly. So, over the next coming days, in the short term, I don't expect the euro to go up really much more than 123.50. You've got a Fibonacci level back in, it looks like 2012. It hit some support, broke through that support, and the old adage, old support becomes new resistance. And so we should see some sellers coming in. For the next short term, I'm going to say the next 2 weeks, we're going to see consolidation. We shouldn't see a huge, after that 2 weeks, that's where the skill comes in, where you look for the price pattern to tell you to get in and out of the market. And, if you watch Shawn in the trade room, he does a fantastic job of legging in and legging out of a trade. So if long term your view is that Draghi is going to be tightening monetary policy and they're going to have a strong euro, what you might want to do is leg into a short term position and hold on to it. Kind of scalp some of the pips off the table, get into a zero risk trade and hang on for the other one. I know I've seen you do that. Maybe you could shed some light on long term what you do.
Well, I think I'm doing the same thing you're looking at. I've in my eyes right now, I'm winding out of long positions right now. I'm looking at that 123.5 extension, and you've got some old support back there in 2014. And so I'm looking at that level and I'm saying, okay, what is the next move? Now, when it hits that level, I'll be looking for some sideways consolidation, or I'll be looking for a retracement, so a downward movement. So I'll be looking for one of those two things to happen, probably on the hourly charts. You'll see it easiest on the hourly charts. And during that, I'll be trading volatility, just obviously on the short term, trading the up and down movements, trying to follow the hourly trend. But then I'll be looking for any signs of breaking that 123.5, because I think if we break that 123.5, I'm going to be pouring money into the euro, and I'm going to be holding on to it. I'm going to be targeting the next level at 125. So I'm right there with you, Nate. It could reverse, it could pull back, but I think that I'm going to be waiting for that consolidation, waiting for a retracement. If we get the retracement, I'll trade the reversal. If I get the consolidation, I'll trade the breakout.
Yeah, so notice I want to point out to the traders here, you're not going long tomorrow.
No, no,
Right.
definitely not.
You're waiting for the consolidation to happen before we do anything long term, or the reversal. It's either going to go sideways, which you're calling consolidation, or it's going to pull back, which you're calling a pullback, or a reversal, and then you're going to go long. That's the only time you would hold a long term position, 4, 6, 8 months, whatever it is, and that's the wealth play that you're talking about, that you do,
Yeah.
right?
Yeah, it's more of a wealth building move as opposed to an income move. So, what do you guys think out there? Any other thoughts? Any other questions? Dave?
Do you see any signs of the U.S. dollar money supply reducing in the foreseeable future?
There's one scenario where the U.S. dollar money supply will start to reduce, and that is if China stops printing. So if China goes into a more tightening policy, then all of that money flow, that cookie sheet, that cookie pan that's moving all that money into the U.S. dollar, all of that stops. The flow of money stops into the U.S. and I think that's the scenario that changes everything. So, while on one hand I've got my eyes on Draghi, I've got another pulse on China and what is happening with their economic tightening versus easing policies. So, because I think that is right now, if I had to pinpoint the flow right now of money, it's from China. So,
but China's not planning on stopping anytime soon. I mean, they got their mouths to feed, and so again, they'll be like anybody else, right? They'll come out and they'll announce it. Hey, we're looking to tighten, or you'll see signs of them wanting to tighten because of something in their economy happening, and so you look for those indicators to tell you. But right now, it's all sunshine and roses for them when they're printing money, right? And so I don't see it stopping in anytime soon.
Hey Nate, what happens if China stops buying U.S. debt?
What if China stops buying U.S. debt? Well, then you're going to see the pressure, you're going to see the money flows stop coming into the U.S. dollar, and you're going to see a weaker. You're going to see the money flow. You're going to see the money flow out of U.S. dollars, and so you'll see a stock market pullback, and you'll see actually a rally in the U.S. dollar. You'll see a strengthening of the U.S. dollar.
Yeah, I'd agree with that. Another thing to consider is you've got another area. So in the past, a lot of currency strength has been driven by the strength in the bond market, right? I mean, China was the premier holder of U.S. debt. Well, that policy has changed a long time ago, and we've seen them reduce their purchases of the U.S. debt over the last, several years. And so that trend's going to continue. But there's another way that that money is flowing, and that is, you've got these sovereign wealth funds, you've got these central banks. And, we've had something unprecedented happen in the financial markets, and instead of these players only living in the bond markets, in national debt, well, these players are now moving into commercial debt. They're moving into real estate. They're moving into speculative assets like the stock market. And so it's like, okay, this is a real game changer right now, because you've got entities that print money. They have their own printing press. They want more money. They just go print it. And they're taking that money and they're investing it in the stock market, right? They're not buying U.S. government debts. They're not buying other country debts. They're putting it into the stock market. Well, then they turn around and say, well, I've got all this debt and I've got all these assets. Now I've got to pay back the debt. So what are they doing? What have they been doing on the interest rates? Well, they also control the interest rate. And so they've lowered these interest rates down to, 0, the zero bound, and in some cases even less than zero, right? And so they're printing money, investing in assets, lowering the interest rate, the cost of borrowing and going into debt. And then they're turning around investing more money into the markets. It's the rinse and repeat. And so you've got this enormous amount of money flowing into these speculative assets. Another question?
Yeah, let's say this will be the last one.
Okay, another question.
And if the PRC were to reduce the purchase of U.S. debt, wouldn't that cause an increase in the U.S. interest rates, making it more attractive for other countries, notably emerging markets, to buy U.S. debt?
Well, in a sense, if they stop purchasing, if China stops purchasing U.S. debt, right? So now all of a sudden prices are going to have to start to decrease, which is going to put an increase on rates, right? So because prices of bonds will have to drop and rates will have to go up. So that will have an effect of increasing rates. And, going back to one of the principles that we talked about earlier in this presentation is that interest rates rising in the U.S. should strengthen the dollar. We should see dollar strengthen. So again, we look at that. We look at what the action in China is. And, we can extrapolate, if they stop purchasing debt, then it will be a synthetic raise of interest rates. And we should see the dollar raise. But you've got all these external functions also playing an impact on pricing. So what used to be the big fear of China not buying U.S. debt is now a smaller fear because the impact is going to be offset by some of these different money flows. I hope that makes sense. That's kind of the way I see it. I mean, everybody will have their own opinion on stuff like that. So anyway, well, traders, so great to be with you. Always look forward to these opportunities to spend some time with you. Thank you, Nate. Appreciate you coming in, spending some time with us this morning. I kind of like this. I like this dual presentation setup. Takes a little of the pressure off of me. Traders, we hope you've enjoyed it. Make some comments in the comment field if you have topics you want us to cover. If there's ideas you want us to explore, let us know. We're happy to talk about what you're interested in. So make some comments. We'll be looking at those comments in the coming weeks. Don't forget to enter your trades on our Facebook page. We want to see those trades. We want to see you trading. So remember, a trade a day. Any other comments, Nate? Anything you want?
No, we just appreciate you guys coming, and hopefully it's been valuable and worth your time. But yeah, we're gonna be doing these. Hopefully you'll have me back. I'd love to be back. We've had a couple people want us to talk about cryptocurrencies. There's been a couple other topics, so we'll get to those for sure.
Absolutely. Well, traders, thanks for being with us today. Happy trading. Go fight trade. Thanks. We'll see you. Bye.